Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull bear point and figure market breadth summary chart for October 7th, 2018. Market breadth. With this past week's market decline, our bull bear point and figure ratio at 0.47 fell from 0.69 last week. The total count of securities in bullish or bearish patterns decreased 3% to 3,146. The count of bearish stocks increased 12%, while the count of stocks in bullish patterns decreased 24%. The Pirls P&F Market Breadth Summary Chart shows us a market now 5 weeks in bearish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 196 points for the 13th decline in 17 weeks. At a negative 169.51 points, it continues below all 8 tops above plus 100 in the last 30 months, and it has fallen below the April 2017 bottom, continuing above all 3 remaining bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in accumulation mode on higher average daily volume. Momentum. The CCI 20 daily, now at a negative 234.99, fell from a positive 76.82 last week. At Tuesday 9:25 close, the CCI 20 daily formed a new zero-line reject long entry trade with a pivot within the plus or minus 50 range. At Tuesday 10:2 close, the CCI 20 daily fell below plus 100, triggering our exit from the trade. The result of this trade simulation was a gain of 22.97 points on the Nasdaq, or $1.51 per share of QQQ. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 127 weeks ago, while the daily CCI 20 began a Woody's uptrend 12 weeks ago. The CCI 20 weekly fell to a positive 40.93 from a positive 104.32 last week, entering the plus or minus 50 range required for a valid zero-line reject long entry signal possible if the CCI 20 weekly rises early next week. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: oil, oil services, and brokers on the top. Some tech on the bottom. Bullish, brokers has entered the top 5. KBW Bank has left the bottom 5. Bearish, semis, networkers, and disk drives have entered the bottom 5. Oil and oil services continue in the top 5. S&P Retail and Comp Tech have left the top 5. Focus this week from www.dollarcollapse.com. Notice how quickly market psychology changed. The following are some key points. How did you go bankrupt? 2 ways. Gradually, then suddenly. Ernest Hemingway, The Sun Also Rises. On the surface, nothing much changed last week. The Fed, as expected, raised short-term interest rates very modestly. The U.S., Canada, and Mexico cut a new NAFTA deal, kind of a pleasant surprise. Unemployment fell again. Trump continued to tweet while Democrats and Republicans continued to express their mutual disdain via dirty tricks and contrived insults. Business as usual, in other words, in our dysfunctional new normal. Yet, for some reason, financial market psychology suddenly shifted from euphoria to terror. Long-term interest rates spiked. The dollar rose, and stocks tanked. The Nasdaq especially was slammed by the sudden reversal of its previously bulletproof fangs. What happened? This cycle's housing boom had been moderating since June, but lately the bottom seems to have dropped out, generating headlines like this. Manhattan home sales tumble in market clogged with listings. Vancouver home sales mark steady decline. For-sale home supply surges in hot West Coast markets. Bond market bloodbath likely to hit mortgage rates soon. And the emerging market crisis, easily managed if the dollar just went back down, suddenly feels permanent as rising interest rates pull the dollar along for the ride. Here's a recap of last week's EM action courtesy of Doug Nolan's Credit Bubble Bulletin. The South African rand sank 4.3% this week, with the Chilean peso down 3% and the Colombian peso falling 2%. Asian currencies were under notable pressure, with the South Korean won down 1.9%, the Indonesian rupiah 1.8%, the Indian rupee 1.7%, and the Thai baht 1.6%. The Russian ruble declined 1.6%, the Polish zloty 1.3%, and the Turkish lira 1.3%. As for major equities indices, stocks in both Turkey and India sank 5.1%. Equities fell 4.4% in Taiwan and 3.7% in South Korea. Argentine stocks sank 9.8%, with Mexico down 2.9%. As much as currencies and stocks were under pressure, the more ominous EM moves were in bond markets. 10-year local sovereign yields 33 BPS in Indonesia, 26 BPS in Russia, 21 BPS in South Africa, and 14 BPS in Hungary. And dollar-denominated EM debt provided no safe haven. Venezuela's 10-year dollar yields surged 70 BPS to 38.55%. Argentina's 64 BPS to 9.9%, and Turkey's 52 BPS to 7.86%. 10-year dollar yields jumped 19 BPS in Indonesia, 19 BPS in Chile, 18 BPS in Russia, 17 BPS in Mexico, and 14 BPS in Colombia. The lesson? When market psychology changes, it frequently does so overnight from the point of view of people who weren't paying attention. But for those who were watching things deteriorate under the surface, the change is actually long overdue. So the real question isn't, why is everything changing, but why did it take so long? And, of course, if this is the start of another 2008-style great unraveling, how can we profit from it? Right now, the obvious answer to the second question is to short everything in sight, joining the long-suffering short sellers who on Thursday and Friday made back a small bit of their past few years' losses. And last, but definitely not least, how far out of control will central banks allow the leveraged, speculating community to spin before they reverse course and start cutting interest rates and ramping up next-gen QE programs? And how deeply negative will interest rates have to go to stop the bleeding? If this sounds like paradise for precious metals, that's because it is, in theory. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. For Sand to Pirls Stock Market Commentary, I'm Cynthia Pearl, hoping that you enjoyed a peaceful and pleasant weekend, that you are beginning a prosperous and productive week coming up, and wishing you true success.